Hello, everyone. Today on the Final Bar, my guest is Chris Vermeulen, joining us from the technicaltraders.com. He's going to share with us some of his thinking, looking at large versus mid versus small, certainly an important topic as we look at some of these captors actually starting to participate in this market uptrend, where you're certainly seeing higher prices is with the equity markets, the S&P closing about 0.7% higher on the Fed meeting. Happy Fed Day. What does that mean for the charts? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of technical analysis, using the charts to better understand investor psychology, sentiment, breadth, trend, momentum, all of that good stuff, and to focus on what the market is pricing in, how we're anticipating, things coming out, and then how we digest those afterwards. And so when you look at the market on a day like today, Fed Day, when you have the two-day Fed meeting, the announcement this afternoon, Powell's press conference, you can see the behavior in the S&P leading up to that announcement. You can see what happened during the press conference afterwards with the S&P moving onward and ever upward. At some point, the market goes down after a Fed meeting, but today is not that day, apparently, as we continue to push higher. What we're going to talk about today is looking at some of the key guideposts. Now that this Fed meeting is behind us, now that the market is starting to digest what we've heard, what happens between now and year end? We're in the seasonally strongest part of the year, so the bias overall, based on the seasonal trends, is stronger equity. So where are we seeing opportunities? Day like today, consumer discretionary, number one. Perhaps some opportunities in there we can uncover together. We have great guests on the show. I'm excited for Chris Vermeulen to join us in a little bit here today. Coming up tomorrow on the 4th, we have John Kosar from Asbury Research. Next week, we have two great guests lined up for you, Larry Tentarelli from Blue Chip Daily and Joe Duarte from Joe Duarte in the moneyoptions.com. Couple quick things, actually one event to point out to you coming up this Saturday. Art Hill, who's a longtime StockCharts contributor, really a lot of the chart school content, a lot of the helpful videos that you find on StockCharts that explain technical analysis. Arthur was a big part of that and really helped design a lot of the educational content that we have. We asked him to do a special event, which he is entitled Trend Following Theory, Expectations, and Reality. When I think about the benefits of following trends, the benefits of analyzing price momentum, I think of Art and the work that he's done over the years. So definitely worth checking out coming up this Saturday. Also, our next episode of The Pitch, I believe, is coming up next week. So go to stockcharts.com/thepitch for all the previous episodes and that next one coming up next week. Let's continue on with our market recap. We're going to start with the poll questions. We always have a poll running on our live stream page on stockcharts.com and also going out on social media. I asked you recently, know your indicators. What is a bullish divergence? I am happy to report that most of Final Bar Nation did just fine with this one, with 70% of you answering correctly. Bullish divergence, lower price, higher RSI. So that's when the price is going down, but the momentum basically stops going down. So the reason why that's a bullish divergence is price going lower, but less downside pressure. So it shows you, it sort of implies that people are accumulating on price weakness, and more often than not, that's a bullish signal for the chart. Those of you that answered something different, I would encourage you to go to our StockCharts chart school section and focus on RSI, in particular where it talks about divergences. Now, I mentioned that with RSI in particular, but it's worth noting you can do that with a lot of different oscillators. People do that with MACD or PPO. With breadth indicators, you look for divergences, and that's just when some sort of indicator, some sort of derived indicator from price or from volume or sentiment disagrees with the direction in the price behavior. And the idea is the momentum leads price, right? Momentum tells you where the price is most likely headed next. Let's continue on with today's market recap. So Fed Day, right? And so what usually happens on a Fed Day is kind of what happened today, which is sort of a lighter volume and sort of wait and see mode up until 2 p.m. Eastern. So you see now it's sort of the 2-day little chart here is compressed quite a bit because we had the rally, in the last couple hours. But overall, sort of a flat session leading up until the announcement. 2 p.m. You get the minutes. 2:30 you start the press conference, and you can see based on Powell's conference, the press conference, the market overall moving higher. So the S&P finishing up about 2/3%, mid caps up 1.1%, small caps up 2.1%. Small caps lagged behind yesterday, if I remember right, and really reemerging and re-exerting its leadership role, popping to the upside today. The VIX, by the way, back below 16, nearing 15, which is really the lowest level it's been year to date, if I remember right. We've touched the 15 level a couple times, and that has so far been a pretty good signal that the uptrend is at the very least going to pause a bit. So worth noting that chart of the VIX and seeing where we're at relative to 15, which has been sort of the unofficial floor for the year. Interest rates chopping around quite a bit, and you saw a lot of movement during the press conference and afterwards, but overall 10-year yields finishing higher around 158 and long bond yields just below 2%. So that we've talked about the importance of that chart, and I think yesterday with my guest, Joe Rabel, we talked about interest rates and the importance of looking at the TNX. I would argue if there's one chart to understand the leadership situation and what's going to work and what's probably not going to work, or put another way, what's going to lead and what's going to lag most likely, the chart of the 10-year might be the way to do that, because higher rates have implications for value stocks over growth stocks, for financials, improving relative performance. Lower rates tends to be a really good tailwind for growth stocks. And so watching that 10-year yield, where we're at relative to this range we're in right now, which is between 150 and 175, I would argue pretty important. Elsewhere, we have gold down for the day. Silver actually finished in the green, but it was a slog. Most of the day was spent below the zero line, and gold did not make it back to yesterday's close. So when we talk about, it's funny, the Fed finally acknowledged inflation is elevated, I think was the word that they used instead of transitory. It was elevated, but still transitory, based on transitory catalyst or whatever, however he described it. So gold, the inflation hedge that many people think about, not really recognizing inflation risk, down 0.8%. Finally, we have cryptocurrencies sort of mixed, right? And if you look, I think there's a danger always of thinking of an asset class as one thing. I find people make that mistake with commodities a lot, talking about commodities overall and whether they're strong or weak. You have to remember that commodities include a lot of different things. You have agricultural commodities, you have precious metals, you have energy, all kind of grouped together. Same thing with emerging markets. Emerging markets could be China, India, Brazil, and those three charts actually look very different. They've had very different return profiles. Same thing with cryptocurrencies. I think if we oversimplify, we think of cryptos as one thing. What we have to remember is that while there's certainly going to be some similarities, there's a lot of movement and a lot of differentiation at times. And this is one of those days when kind of half of the top coins that we track were up, half of them were down. Ether finishing the last 24 hours up 0.9%, Bitcoin down about 0.5%. As we talked about, Bitcoin is sort of in that breakout range. 60,000 was a key level. 64, 65,000 was the previous high. We got above there and now retesting that breakout point. And remaining above 60,000 certainly would be a fair expectation if you're bullish on Bitcoin. Let's continue on looking at the chart of the S&P 500. So I was taught a number of things that were phrases that were often repeated to me at times in my career. If you follow nothing else, look at a chart of the S&P 500. That was a Ralph Acampora paraphrase that he would throw around a lot. The worst mistake an analyst can make is remaining bearish in the face of a rising market. The most bullish thing the market can do is go up. These are things I was told as a reminder that follow the trends, right? And when the trends are up, when the market is going higher, it's fair to expect that that's going to continue. I think based on moves like today, where you just see continued follow through, tell the tale of a market that's in a bullish phase. I get the idea that we're overextended. I get the idea that we're overbought. I get the argument that the market has gone up quite a bit with very little pullbacks. All of that is true, but the market doesn't care about all of those things. It's continuing to go higher. And I would argue the most important thing is to follow the trend. We're in a pattern of higher highs and higher lows. That's the definition of an uptrend. Until that stops happening, overall, I'm going to assume that the path of least resistance remains positive. So renewed strength in stocks. And it's not just the S&P, by the way. When I'm screening for names, and earlier today for my own clients in market misbehavior, I was running screens on 3-month highs and lows, and I was not struggling to find stocks making new swing highs. And to be honest with you, it was sort of focused this time this week on two particular sectors, maybe three if you group technology in there, but it's a lot of financials, it's a lot of consumer discretionary. And it's charts like this. CMA is a good example of what a lot of the banks look like. I've had a really good run into the second quarter. This is when a lot of the banks topped out in April into May. Then June, July, you saw some pullback in CMA's case, Comerica back to the 200-day moving average, now rotating back higher, getting above those previous highs and following through to the upside. So when you think about what these banks are pricing in, I would argue it's pricing in higher rates. It's pricing in that environment that's going to be very, a good tailwind environment for banks, meaning a set of conditions that are going to make it easier for these banks to make money and to profit going into next year. And the charts are certainly reflecting that sort of outlook by people bidding the prices higher and higher. Within consumer discretionary, there are a lot of interesting charts, but I'm reminded of charts like this when people ask me whether or not that you should be leaning more bullish or bearish. Charts like BBWI, charts like Microsoft, that are sort of the up and to the right types of charts, the long and strong charts, as we used to call them. Condition charts like this happen during bull market phases. And when charts like this stop working, that's when you can start to be concerned. Now, there were a lot of names that had done very, very well going into the second and the third quarter, took a bit of a breather, but now sort of reemerging and going to the upside. So charts like this breaking to new highs, the relative strength improving, tells me there are plenty of opportunities here, riding potential strength between now and year end. And that's certainly where I would be trying to focus. We need to take a quick break. We'll be back with today's guest, Chris Vermeulen. We'll see you in a minute. And welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we review the charts together, try to draw the lessons we can of market history and focusing on trend and momentum and the lessons we can learn from the prices themselves. A couple quick announcements before we get to today's guest, Chris Vermeulen. Number one, we love to hear your questions. One of my favorite parts of this show is the interactive nature of it. We received so many great questions from you in our couple of years of running the show. We're going to do another mailbag segment in today's show a little later, answering questions from you in the last day or two. We'll do another mailbag segment at the end of the week on Friday's show. We love to answer your question on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. Hope to answer yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We put out so much great content every trading day, even sometimes on the weekends. Great guests like Chris Vermeulen, Joe Rabel, and others. Special events like The Pitch, our year-end review coming up in December, our 2022 market outlook coming up in January, and much, much more. Go to StockChartsTV.com. You can use your email address to set up a free account, or on any of your mobile devices, search on the app stores for StockCharts TV on demand. I want to welcome on today's guest, Chris Vermeulen. Chris has joined us before from Ontario, from the deep north of Canada, and runs the technicaltraders.com. Chris, it's great to see you and welcome back to the show.
Thanks for having me, David. Pleasure to be here.
So we were in a situation here on Fed Day where the S&P and the NASDAQ continuing to push onward and ever upward, but it's not just the large caps that are actually doing it. We're looking at a chart of the Russell 2000 ETF. What is it telling you based on the patterns you're seeing here?
Yeah, well, all year we've been seeing the large caps, the big blue chips just grinding the market higher. And really all the leading sectors of last year have been dormant. They've all been pulling back. We just haven't seen a lot of sectors popping and running like we did last year. And so now we're starting to see this money start to trickle down into the mid caps and the small caps. And that's why we got the Russell here, is the Russell's finally starting to break out. And when the Russell and the transportation index and the mid caps are all starting to run and break, that is like kind of the sign that, hey, money is willing to get back into these risky stocks, and it's going to dive in and it's going to jump in with both feet and buy this risk up. And you can really see it on the charts. Just today alone, we're seeing crude oil down 4%, gold down, yet the XOP ETF, which is very lucrative oil and gas stocks, gold miners like GDX, they're actually rallying on a day when the commodities are getting hammered. And that's a sign of the small cap investor. The risk on is back in the game, and the Russell is signaling that.
It's such a great point, and I think a lot of people, and it's fair over the long term, right? I mean, some of those stocks certainly tend to align pretty well with the commodities, but when you get a disconnection like you're seeing today, it's more about the risk on sentiment, right? It's more people putting the bets on. Here on the second chart is a mid cap index, same thing, right? Making new all-time highs again.
Yeah, exactly. I mean, money's starting to pile in. You look at like the ARK ETFs, which to me is kind of like the small cap. It's a really speculative, aggressive traders. They have started to turn up. They're in rally mode, and it's almost like looking at the Russell. People are piling back into these very aggressive and growth type stocks, right? So when you see this, I mean, it's pretty exciting based on my cycles and everything. I'm looking for this market to really continue to run right to the end of January. Seasonality wise, as you mentioned earlier, this is it. This is the sweet spot. Cycles are up. Everything's just starting to break out. So hope and pray this trend really just takes off into the beginning of the year.
So you're seeing a lot of renewed strength. And you mentioned, Chris, the seasonal tendencies. And you're right. I mean, November, December, January tend to be pretty good for stocks, particularly going into year end. Now, when you're looking at the S&P making new all-time highs, mid caps and small caps, the NASDAQ, and it goes on, transports, right, breaking out. Where are you looking opportunistically? If that is the case, and if markets are going to go higher, where would you be looking for to put new money to work today?
Yeah, I still really like the energy sector stocks. I think oil's getting a little long in the teeth. I think we're going to see crude hit 88, 89. And then I think it's probably going to top out. Probably see the energy stocks probably top out, but I still really like that. I like the banking and I like the financial sector. I even like solar, like TAN, and I like Hack, which is like the electrical vehicle, or sorry, the cybersecurity ETF.
Yeah,
I kind of like all those. They're coming back to life again, and they got some upside potential.
it's interesting. A lot of those things you mentioned, like Hack, the cybersecurity ETF, solar stocks, these are some names that had been beaten down a little bit, but now really starting to reemerge. Well, just one more question, Chris, if I could. So as you see things reemerge, and it's hard to disagree with your sense that things look very constructive. I'm always thinking of the alternate scenario. What would you need to see that would make you less optimistic? Because it seems like everything's firing on all cylinders. Yeah. Market's going higher. There's nothing to worry about. So what would we worry about, right? Is there something you would see that would tell you things are not as ideal as they seem?
Yeah, more or less. I like to see, look at intermarket analysis, what other sectors and asset classes are doing. If the stock market starts to struggle, the indexes, we see bonds really start to move higher. We see utility stocks continue to really start to rally. Maybe gold starts to hold up more. If we see those things start to outperform the indexes, that to me is always kind of a red flag. When money's going into those defensive sectors, that's usually just be careful, because this market could actually follow through to the downside on a breakdown. And so I like to make sure those are not outperforming. You want the stock market to be beating the boring old utilities and bonds.
That's such a great point. We're so focused. I've been so focused, even on the show today, so much on the strength in a lot of these offensive sectors. You pointed out a really good point, which is the defensive stuff is really struggling. And that's maybe arguably even more bullish, that you're seeing weakness in the defensives. Chris, it's awesome to have you on. When I have you on, I feel like we could spend an hour or two just talking about some of these charts, but I'm thankful for 5 minutes with you. Be safe, stay well, and we'll talk to you again soon.
Thanks, David. Same here. Take care.
That's Chris Vermeulen. Chris is the founder of the Technical Traders, coming to us from Ontario. I was super jealous, as he was telling me before the show, that snow is coming down in Ontario. Here in the Pacific Northwest, we don't get a lot of snow unless you go up in the mountains, where you get plenty of snow on Mount Rainier and elsewhere. But other than that, I love his take. And that last point, I think, was really well done. I had a similar conversation with Julius de Kempener earlier today. We were doing an event for the Money Show Virtual Expo, talking about sector rotation. He made that exact same point, which was, it's not just that offense is working, it's that defense is not working. And that is arguably even more constructive. What would I, and I love asking people like Chris, what would you need to see to be less bullish or to be less constructive? And I thought his point was a good one, which is look at the relative strength of some of those defensive sectors. So far, not telling you anything to be concerned about. Let's continue on with our next segment, excuse me, which is the final bar mailbag. As I mentioned, we love to get your questions. Nothing is out of bounds. Questions on technical analysis, technical indicators, particular charts or ETFs that you're struggling to make sense of. Our email is thefinalbar@stockcharts.com. We love to hear from you. Let's get to our first question. This was a longer question. I'm gonna summarize a little bit and then get you to the guts of the question. Basically said, I've been watching the markets go up recently. There are some ETFs that I wanted to buy, but they just kept pushing the Bollinger Bands higher and higher. The bands get wider and wider, which certainly happens when you see something accelerate. Finally, at the end of October on the 26th, I decided to buy transportation and regional banks because I was afraid, and that is a key word, for fear that they would just keep advancing and I'd never get my positions. Well, I bought, and then on the 27th, both industry groups got whacked pretty hard, and so did I. And here's the point of your question, what sage advice can you offer to deal with the push and pull that I feel about timing purchases and sales? And I think what I love about your question so much, and thank you for sending that in, is I think the words fear and feel came up in your question. I think that has a lot of great information right there. The challenge that you're facing, I think, is the mental state of dealing with the fact that there is a lot of uncertainty and being afraid of the market going against your position. And what I would encourage you to do is try to unpack that, try to unwind that. You mentioned things like banks coming off, and these are the days. If I'm looking, I think these are the days you basically mentioned, right? The financial sector breaking out, all of a sudden it pulls back, and you feel like it was a total miss. So a couple of things I would say. Number one, what we want to get away from is making decisions and being impacted from the emotional state. When I relate investing to flying, it's because I've seen that pilots are given a set of tools and rules and processes to minimize their the emotional impact of the decisions, or basing their decisions based on emotions, because that will certainly not help you navigate things when you're up in the air and you have to be balancing a lot of different things. You don't want emotions to be part of the decision. Investors, you have the same challenge that you're trying to minimize. So I would say, number one, let's get away from words like fear and feel when you're talking about your investment process. The second thing is remember your time frame. So, when you see a stock making new all-time highs, I often highlight those things, but how you actually scale into a position is something I would spend some time thinking about. What you find is when something initially breaks out, that is maybe when you take an initial position. Then you get a bit of a pullback a little later. That's maybe when you add the rest of the position, right? Or maybe just because something is running, you wait to see some sort of pullback. And that pullback you got in the XLF, where it goes down to 40 here about a week or so ago, that's the time when you get into it. So buying into long-term strength, but short-term weakness. So if you're thinking down the road, if you're thinking a little longer term, don't be afraid to buy at the all-time highs and give up a little bit as the market goes through its normal fluctuation. Remember, in the short term, the market tends to mean revert. On the long term, the trends tend to evolve. So those would be my two things for you. Number one, think about your time frame. Number two, try to unpack some of those things. I'm picking up danger words like feel and fear, and get away from that. Focus on the evidence, and don't be afraid when something goes against you. That's just the nature of the game here. Next question, how do the S&P futures work? Since the S&P is an index, that's just an average of all the underlying stocks. When those stocks aren't trading off hours, how are the S&P futures still trading, and how is the price determined during those off hours? That's a fantastic question. And there's this thing, if you just Google the phrase index arb or index arbitrage, you will get the answer to your question, but I'll summarize it for you. This is one of those things where the free markets actually have a beautiful design, right? And so you have the S&P 500 index, and you have the futures that are based off of that index, and you have E-minis and all of that are based off the price of the stock. So as the price of the stocks fluctuate, the futures move in line with that. But what happens after hours? So there's this things called index arbitrage, and big firms spend tons of effort arbitraging the indexes, meaning if the value of the future gets too far away from the value of the underlying assets, they'll buy the futures and they'll sell the assets and sort of bring things back in line. If things get overheated, they'll do the opposite, and they literally make an entire business out of keeping the futures in line with the indexes. So if it gets too far away, they'll make the trades that they need to either sell the basket of S&P names and buy the futures, or the opposite, to sort of bring things back into proper line. During the trading day, things don't become disconnected because they are actively doing that at all times, and they are just trying to do the tiniest little things. Index arb is not a big, huge swing. You won't even know it's happening because they're doing little minute changes to try to keep things as closely, and basically to keep the future trading as close as possible to its net asset value, or the value of the underlying assets. After hours, things can get a little bit more disconnected. It tends to be a little bit less liquid. The big players are not participating in the futures market. That's why the E-minis overnight can be really interesting to get a read on retail traders. What happens is once these stocks trade again, 9:30 a.m. the next morning, you will see some initial movements that'll bring the futures right back in line with where they should be trading. So look up the phrase index arb or index arbitrage, and that will give you a lot more detail on everything I just described to you, is how I would say it. Let's see, on the chart of eBay, would it bother you that the relative strength line failed to get above the June 2020 high? Is this a form of non-confirmation, or am I reading too much into it and I should just understand the outperformance is still there? And I think you're talking about this, I believe, which is when the stock is making new highs here and getting above its June 2020 high, but the relative strength not quite doing it. Really interesting question. And, does that bother me? No. Would it be ideal if the stock was making new price highs and new relative highs? Absolutely. That would be a much more idealized price behavior, right? Which is the price is going higher and the relative strength making new highs tells you that it is dramatically outperforming other stocks that you could be holding. So that's the ideal situation. This is a little less ideal, which is the price breaking to new highs, the relative strength not quite confirming it. But however, I'm more encouraged by the fact that the relative strength is trending in the right direction. For me, the most important thing is the trend in the relative strength, because these values, the ratio that you're looking at is not necessarily as meaningful as the direction of the relative strength. So what we would often look at on the institutional side is the trend in the relative strength, the slope of the relative strength, to show how quickly something's outperforming and doing a lot of crazy things to try to more standardized relative strength across a lot of different assets. But overall, I think very simply, buying stocks where the relative strength is going up is more of a positive than the potential negative of the price going making new highs and the relative strength not confirming that. But you will hear me if you listen when I talk about charts. I'm sure I mentioned, I don't know if I do, but I'm betting I probably do. I'll often talk about a stock making new price highs, new relative highs, and that's keying on that, what you're not seeing on eBay just yet. So overall, not the end of the world, and I'm much more encouraged on this than a stock where the relative strength is going down. But that's the reasoning. That's the reasoning there. We're out of time for the mailbag. I always wish we had so much more time for it, but I really appreciate your questions. Keep them coming. We've gotten so many great questions from you guys, and we're happy to continue to do it. Shoot us an email, thefinalbar@stockcharts.com, with any questions you come up. This last question, you saw someone sent a permalink along with it, which is really helpful. If you do that below the chart you're looking at, that'll help us answer your question most effectively. Let's wrap today's show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is breadth. I color code these every Friday, and I tried not to touch it during the week, but I'm often tempted, and I'm tempted to move these breadth lines more green for bullish, but I will fight the temptation and wait until Friday's close. If you saw on Friday when I was color coding these, it was sort of mixed, right? The S&P and the common stock NYSE 80 lines had both made new swing highs. The mid cap, not quite. The small cap, not quite. Given today's strength after the Fed announcement, I wouldn't be surprised if these lines continue to break to new highs, which would mean all 4 of these have now confirmed new highs, getting above the early September high. Not all of them have made a new high from June, and that will be the next thing we'll be looking at. But if they get above the September highs, that'll be enough for me to signal an all clear and tell you that breadth conditions are overall fairly strong. Chart number 2 is Lyft. Lyft is an earning name this week. A lot of earnings happening. But with the Fed today, we talked a little less about earnings, but we'll keep that going through the remainder of this week. Lyft is one of those stocks with a nice bounce today on earnings. It closed below the open, which I think is noteworthy. If you look, it opened above the 50-day moving average, but closed below it. That's not an encouraging sign if you're a long-term constructive on Lyft. It did finish today up 8%, which is overall very positive. But what concerns me about this chart are all these lines that I've drawn on here. Overall, on a longer term basis, looking at the last 8 months, it's made a consistent pattern of lower highs. That's concerning. Really not making a lower low. And I think there's a potential floor here in this stock around 42, 43 to 44. These are the lows from January, May, August, and October. However, until the price gets above trendline resistance, until it regains the 200-day moving average, overall, this is still a chart in a downtrend. And I think the relative strength index, the RSI, remaining in bearish phase is the most damning piece of evidence on the chart. Finally, Microsoft, I was mentioning with Chris Vermeulen talking about small caps and mid caps breaking out, but with large caps that have already done very well. And I'm struck by charts like Bath and Body Works, charts like Microsoft that are just consistent, long and strong uptrends. Stocks like this, I would think of as more of a core position. These are the sort of things you trade around. You try to get cute with other positions, but overall, stocks like this and ETFs like this that continue to perform well on an absolute basis, and especially on a relative basis, which is what Microsoft has done year to date. Overall, I don't see anything to not like there. Special thanks to Chris Vermeulen joining us today from Ontario. From everyone at Market Misbehavior, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.